Evaluating the financial health of a company is crucial for investors, stakeholders, and management to make informed decisions. Here are the key steps and metrics to consider. Analyze financial statements. Balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. Key metrics to examine include the current ratio, current assets divided by current liabilities, and debt-to-equity ratio, total liabilities divided by shareholder equity. Income statement shows the company's revenues, expenses, and profits over a period. Important metrics include revenue growth, gross margin, gross profit divided by revenue, operating margin, operating income divided by revenue, and net profit margin, net income divided by revenue. Cash flow statement highlights the company's cash inflows and outflows from operating, investing, and financing activities. Key metrics include operating cash flow, cash generated from core business operations, and free cash flow, operating cash flow minus capital expenditures. Assess profitability. Gross profit margin indicates the efficiency of production processes by comparing gross profit to total revenue. Operating profit margin reflects the company's ability to manage its operating expenses effectively. Net profit margin measures overall profitability by comparing net income to total revenue. Evaluate liquidity. Current ratio assesses the company's ability to pay short-term obligations with its short-term assets. A ratio above 1 indicates good liquidity. Quick ratio similar to the current ratio but excludes inventory from current assets, providing a more stringent measure of liquidity. Cash ratio measures the company's ability to cover short-term liabilities with cash and cash equivalents. Analyze solvency. Debt-to-equity ratio indicates the proportion of debt used to finance the company's assets relative to shareholders' equity. A lower ratio suggests less risk. Interest coverage ratio assesses the company's ability to pay interest expenses with its operating income. A higher ratio indicates better solvency. Debt ratio measures the proportion of a company's assets that are financed by debt. A lower ratio suggests a healthier financial position. Examine efficiency. Inventory turnover ratio indicates how many times the company's inventory is sold and replaced over a period. Higher turnover suggests efficient inventory management. Receivables turnover ratio measures how effectively the company collects its accounts receivable. Higher turnover indicates efficient credit management. Asset turnover ratio assesses how efficiently the company uses its assets to generate revenue. Evaluate growth potential. Revenue growth rate indicates the company's ability to increase sales over time. Earnings per share (EPS) growth measures the growth in earnings attributable to each share of stock, indicating profitability on a per-share basis. Dividend growth rate reflects the company's ability to increase dividend payments to shareholders, indicating financial health and confidence in future earnings. Consider market ratios. Price to earnings (P/E) ratio compares the company's current share price to its earnings per share. A high P/E ratio may indicate that the stock is overvalued, while a low P/E ratio may suggest it is undervalued. Price to book (P/B) ratio compares the company's market value to its book value. A ratio below the 1st of May indicate that the stock is undervalued. Review industry benchmarks. Compare the company's financial ratios and metrics to industry averages to gauge relative performance. This helps in understanding the company's competitive position and market standing. Examine qualitative factors. Management quality. Assess the experience, track record, and credibility of the company's management team. Market position. Consider the company's market share, competitive advantages, and brand strength. Growth strategy. Evaluate the company's strategic initiatives, innovation capabilities, and expansion plans. By systematically analyzing these financial metrics and qualitative factors, investors can gain a comprehensive understanding of a company's financial health, enabling them to make informed investment decisions and assess long-term viability.